Welcome back to the deep dive, where we take your source material, your articles, your research, your notes, and, well, we cut right to the core of what you need to know. Today, we are strapping in for a really high stakes look at a digital asset that seems determined to force its way back into the center of the conversation. I'm talking, of course, about XRP. You supplied us with a fantastic stack of recent analysis, and it feels like every single piece is driven by one colossal, almost mythical question. Can XRP actually hit $100? So that's our mission today. We're going to unpack the forces making that question even possible, and then the structural limitations that might make it wildly improbable. So let's just start with the current context. I mean, the sources confirm this momentum is absolutely real. As of January 14, 2026, XRP was trading near, what, $2.14? It's gained over 16.2% just this year. That kind of price strength puts that ultra-ambitious $100 question right back on the table.
And that's exactly why we need to do this. We have to move past the exciting day-to-day price charts and look at the structural elements that really determine an asset's long-term ceiling. So to understand if $100 is even theoretically possible, we're going to analyze this in, I think, three parts. First, the crucial regulatory shifts, specifically that SEC settlement that changed the entire playing field. Second, the measurable market mechanics. So, the supply tightening and institutional demand that's driving all this current volatility. And then finally, we have to look at the fundamental use case limitations and the cold, hard math of market cap that will ultimately define its ceiling. The goal here is really to give you a complete picture of why this debate is happening and what the underlying data actually suggests.
Okay, let's start with the big one then. The primary catalyst that really defines this new era for the asset, the regulatory reset. That happened in August 2025. For years, this thing was just trapped under a massive legal cloud. So what was the core finding of that settlement between the U.S. Securities and Exchange Commission and Ripple Labs?
Well, that settlement was the finish line of what you could call a regulatory marathon. And the core finding, really, was the confirmation of a prior court decision. The settlement reinforced the position that XRP itself is not considered a security when it's traded on secondary markets.
So on exchanges.
Exactly. And this was the long-awaited essential clarity that the entire market, especially the big institutional players, have been craving for years.
So we've basically gone from an asset that was, radioactive in the eyes of many U.S. financial institutions to one that's, for all intents and purposes, normalized. What did that restoration of normal economic function actually look like right after the settlement?
Think of it this way. For years, that lawsuit acted as a kind of a regulatory handcuff.
Right.
It severely constrained XRP's addressable market, specifically blocking big U.S. institutional investors, and it decimated its credibility. When the settlement was reached in August 2025, it didn't change the underlying technology or the code at all, but it provided institutional permission.
Permission. That's a great way to put it.
It reopened standard distribution channels. It allowed major regulated institutions to engage without fear of, immediate legal blowback. The sources really emphasize this. It wasn't a technological breakthrough. It was an enormous political and legal weight just being lifted. It unlocks the largest financial market in the world.
That's a key distinction. The asset didn't suddenly get better. It's just that regulated finance was suddenly allowed to touch it again. And speaking of institutions touching it, that regulatory clarity, it coincided almost perfectly with some really fascinating measurable shifts in the market mechanics, specifically on the supply side.
It created a huge market shift, yes. We saw a very significant tightening of liquidity starting in the second half of 2025. The most dramatic evidence of this renormalization is the reduction in tokens held on centralized exchanges.
Okay.
And this is a crucial metric because exchange reserves are the readily available inventory that speculators and short-term traders can access. And that inventory just plummeted. It was sitting at about 4 billion tokens in early January 2025, but by December, that figure was down to a really tight 1.6 to 1.7 billion.
Wow, that's a massive drop, over 50% in less than a year. Why is that specific metric, the tokens on exchanges, so much more telling than, say, the total number of wallets held in it?
Because it speaks directly to immediate liquidity and speculative pressure.
Okay.
The sources remind us that low exchange reserves alone don't automatically raise a price. If nobody wants to buy, the price does nothing. However, when liquidity gets this tight and new demand enters a market, those bids meet way less available inventory to absorb the buying pressure. It's this lack of friction that can dramatically boost short-term price movements, which is what we're seeing right now.
Okay, so shrinking speculative supply. But wait a minute, Ripple itself is the single biggest supply factor in this whole ecosystem. They still manage their vast holdings through those predictable escrow releases. So if the goal is scarcity, how does Ripple's massive predictable supply factor into this sudden tightening?
That's the critical offsetting factor, and you're right, we can't forget it. Ripple continues its planned distribution. Consistent with its long-standing pre-announced framework, on January 1st, 2026, they released another 1 billion XRP from escrow.
Another billion.
Yep. So while the market is seeing this organic tightening on exchanges, the official distribution continues right on schedule.
Okay, so shrinking exchange supply, but it's partially countered by predictable distribution. But this brings us to what might be the most significant structural change post-settlement, which is actively removing tokens from the trading market and putting them into long-term custody. The arrival of ETFs.
Yes.
This is where the story gets really interesting.
Indeed. The U.S. spot XRP exchange-traded funds, the ETFs, they launched in late 2025, and these vehicles are designed specifically for institutional and mainstream investment. Their effect is fundamentally different. They attracted about $1.2 billion in cumulative net inflows almost immediately after launch.
$1 billion too.
Now, we did see a small outflow in early January 2026, which is just normal volatility, but the sheer size of that initial inflow is what really matters.
Okay, 1.2 billion sounds like a lot of conviction, but if we compare that to the scale of other major crypto ETF launches, is that truly transformative, or is it just standard product diversification now that the legal risk is gone?
That's a fair challenge.
Yeah.
I mean, on its own, 1.2 billion might not move a $1 trillion market, but its significance is structural.
How so?
When an ETF buys and holds the asset, those tokens are not sitting on an exchange waiting to be traded or shorted. They're transferred into long-term custody, locked away to back the ETF shares. This action, combined with that drop in exchange reserves we just talked about, means the immediately available liquid supply has tightened even further.
I see.
The ETF inflows are institutionalizing the long-term holding of XRP. It's reinforcing the conditions for some pretty severe short-term price volatility when new demand shows up.
So the bullish case is clear. We have regulatory clarity, institutional permission, and measurably tighter supply. Now let's shift gears. Let's look at actual utility. Because for an asset to justify the hype, and certainly the valuation implied by $100, it needs real-world traction. Do the metrics back that up?
They certainly show robust directional growth. The XRP ledger on-chain activity increased over 50% in the second half of 2025 alone, which demonstrates accelerating adoption post-settlement. And by early January 2026, the total daily transactions on the ledger were approaching 1 million.
1 million a day.
That's verifiable high-volume activity. Plus, the sources highlight that Ripple is aggressively expanding its footprint in key markets like Japan through partnerships with prominent banks, specifically to increase cross-border settlement usage.
Okay, 1 million daily transactions sounds big. And expanding into a major financial center like Japan suggests it's gaining global relevance. But let's introduce some skepticism here. 1 million daily transactions is great for a decentralized ledger, but how does that compare to the scale required of a global financial utility? How does that stack up against, say, Visa?
That comparison is essential for tempering expectations. I mean, you look at Visa, and they process hundreds of millions of transactions every single day. Well over 400 million, easily.
Yeah.
So while the Ripple network facilitates very specialized, high-value transfers, and those transactions are extremely efficient, 1 million daily transactions, in the context of global payments, is still a relatively small figure. The utility growth is undeniable, but the volume is not yet commensurate with the valuation targets being discussed.
So this is the hard truth part of the conversation?
This is it.
Yeah.
The fact is, all these positive indicators, regulatory clarity, tight supply, genuine utility growth, that's what makes the $100 price target seem feasible from a network growth perspective. But you have to face the math.
And this is where the conversation shifts from possibility to cold, hard reality. Why, despite all this success, does $100 still seem so unlikely? It all comes down to the market cap requirement.
Absolutely. When you talk about a $100 price point, you're fundamentally defining a ceiling by the total market capitalization. The current circulating supply is roughly 60.7 billion tokens.
Okay.
So if you do the multiplication, 60.7 billion tokens times $100 per token, you arrive at a market cap that exceeds $6 trillion.
6 trillion. That number is so large it almost loses meaning if we don't put it in context. What does 6 trillion look like on the global financial map?
It looks colossal.
Yeah.
I mean, to give you some perspective, the total estimated value of all the gold ever mined in the world is around 13 trillion.
Okay.
The largest public company in the world at its absolute peak rarely exceeds 3 trillion. The entire global crypto market, including Bitcoin and Ethereum, has only recently gotten back over 1 trillion. A $6 trillion valuation would position XRP as one of the most valuable financial assets in recorded history. It would dwarf nearly every single company.
And to sustain a valuation like that, what must an asset be doing? It can't just be speculation. It needs a fundamental engine.
Precisely. To sustain $6 trillion requires one of two things. Either the asset must generate massive recurring cash flows, which a non-productive digital asset can't do, or it must function as a global, mandatory, essential reserve store of value, something rivaling gold. And this brings us to the critical limitation embedded in its very design. Its primary use is to be a bridge currency for cross-border transactions.
Right. It's designed to be a temporary vehicle, a momentary transfer mechanism.
And here is the core structural limitation. We can call it the optionality paradox. The Ripple Payments Network can, and does, function without strictly requiring the use of the XRP token. The network offers settlement options using fiat currencies or increasingly stable coins. So the growth in the Ripple network, while great for the company, doesn't translate directly or consistently into mandatory demand for the XRP token itself. If a bank can just use a stablecoin instead, the demand for XRP becomes optional, not forced.
That is the ultimate headwind, isn't it? The utility doesn't force token usage. And then there's the whole issue of its core design goal, efficiency. It's meant to be fast, not sticky.
That's the efficiency paradox. It's designed for maximum transactional efficiency, moving money in milliseconds. Think of it like a token for a toll booth. It works perfectly because you spend it instantly. If the system forced you to hold on to it for a month, the whole thing would fail.
Right.
And when money moves that efficiently, less capital needs to be locked into the payment system at any given time. Because it's designed to be a highly efficient temporary bridge, it fundamentally restricts its potential valuation as a long-term store of value. You don't hoard something that's designed to be spent instantly.
So just to sum up that point.
The sources summarize it perfectly, really. They say the long-term growth trajectory remains highly dependent on investor sentiment and broader crypto trends, making $100, and I quote, unlikely in the foreseeable future.
Okay, let's bring this all home for you, the listener. The tension here is palpable because you've supplied us with genuinely transformative news. The regulatory clarity is massive. The utility growth, 1 million daily transactions, the expansion into Japan, that's all undeniable.
That's the strong bullish case, yes. But that success is fundamentally countered by the structural constraints of its design. Its optionality, meaning alternatives exist, and its efficiency, meaning holding it long-term, goes against its fundamental purpose.
It's a payment tool, not a hoarding asset.
Exactly.
So we've established that to get to $6 trillion, you need mandatory, global, persistent, long-term demand.
That's the threshold. So we have to leave you with this final provocative thought to chew on. If an asset like XRP is intentionally designed for maximum transactional efficiency and optional use, does that efficiency inherently cap its potential as a long-term store of value?
Does its greatest functional advantage become its biggest valuation disadvantage?
Exactly. You should consider what real-world financial use case would actually force the asset to be held long-term, to create that massive recurring scarcity, to justify a valuation that puts it alongside the most valuable assets in global history. That's the question. The current utility metrics, as good as they are, still haven't answered.
The perfect thought to consider for this asset's future is its greatest strength, its efficiency, also its greatest structural weakness when you're chasing multi-trillion-dollar valuations. Thank you so much for supplying the material for this crucial deep dive today. We'll see you on the next deep dive.